hosting a tournament. Oh, yes. Well, good evening, everybody. And yes, the live mics. Right, Nick?
They'll get you.
Welcome to the Hump Day Market Update. By the way, I am wearing... Oh, you know what? It's not... Okay. No. Okay. See this? Right here. This right here, ladies and germs. Yankees, game 1 tonight in Houston against the Houston Astros, which, by the way, Nick, I knew for sure. I mean, I think the Yankees played poorly against Cleveland, the Indians, or whatever they're called now.
The Guardians.
I don't think I can ever say that.
When I see it, I'm like, wait.
It's odd.
What?
Yeah. I knew they'd win that series. I thought they'd win it in 3 or 4. Didn't know it had to go 5. Or they didn't play well. But in this series, and I know you're a sports fan, I mean, which is a great thing when you have a female co-host / co-worker / chief operating officer of your company. /
masshole.
What'd you say?
Masshole?
What is that?
Like a Boston asshole?
A masshole?
Yeah.
Oh, okay, so you're a masshole. You're a
Yeah.
masshole.
So it's kind of funny, though, because I've checked out a little bit as far as baseball goes. So
okay, yes, because your baseball season's over.
Yeah, it's been over.
Yeah. But anyway, my baseball season's still going.
And the Yankees are going to do great. Capiche?
No, I just don't believe they're going to be able to win this series. But,
Don't be a Bostonian. Don't be negative. Have some positivity.
I'm trying to be negative Nick here.
I see that.
And here's why I think. Because, first of all, their bullpen's a disaster. They got tons of injuries in the bullpen.
You don't have a lot of recovery time, too, from your bullpen.
They not. And they live and die by the home run.
Yeah.
And when I saw Cleveland beat them by 1 run, and they had 15 hits, and the Yankees had 5. They scored their runs on home runs. So if you don't have the long ball, you're in trouble, and that's where they are.
Bombers.
Anyway, good to have you here. It is Wednesday, October 19th, and this day is a very important day in history, by the way. It's the 35th anniversary of the big 1987 market crash, which is you weren't even born yet at that point.
Black Monday, though.
Black Monday.
Excellent show as well on Showtime about the stock market crash of 1987.
Yeah, I was watching. I think is it still on or is it done?
No, I think it's done. But It's got Don Cheadle, Regina Hall, fantastic cast, and I'm a sucker for those kind of shows.
I got in the business. This happened October 19th, 1987. I got in the business May, so call it June of 1988. So I was fresh off the crash. And, it loomed large because the 1987 crash dropped 22.8% in that day. 22.9. The point amount doesn't seem like a lot because we were down more than that last week one day.
Right. We're looking at it with today's lenses
right.
As far as the points are concerned because it was,
Well, because the Dow was around 2,500-ish.
Right.
So,
So losing 508 points on a single day is quite a catastrophe.
Yeah, it is. And so it lost 508 points on that day. And Alan Greenspan was the Fed chairman. And the next day he came out and said that the Federal Reserve is here to help liquidity needs for the institutions, the banking institutions. And, the market recovered. And it always does.
So for once, it wasn't their fault.
It was not their fault.
They were the savior.
They did come in, but the Fed would come in if something like that happened.
Yeah, absolutely.
I mean, right now they want it to happen
during COVID.
Exactly, but they want this. They want the market to correct. They want us to feel not as rich, or they want us to feel the crunch because when you feel the crunch, you spend less money.
Yep, that's the whole point.
I mean, I know people that have held off making major purchases because they go, I don't know. When your portfolio's down. And I know somebody who just said, my 401k is down $150,000 in the last this year. So I don't know, even though you're not going to touch your 401k for a while.
Right.
Just people, when you don't feel as wealthy or you feel just poorer, it's always a problem. And that's what the Fed is trying to do.
There's less of a safety net.
There's way less of a safety net. So let's go to what the markets did. I can't find it. Where's it at? Is this it? Nope.
Yep, StockDr.
Nope, that's
Other
not what I want. Oh, the tab. Oh, you made me do other tabs, and I'm not sure about how to play that. Okay.
You can do this. I believe
Okay.
you.
So, the Dow Jones, if you could see this here, the Dow Jones Industrial Average was down just about 100, just a business outside, just about 100 points at 30,423. The S&P 500 down under 25 points at 3695. The NASDAQ Composite down 91 at 10,680. Small cap stocks were down about 1.5%. So small cap stocks have been doing pretty well and leading the way, really. I mean, lately.
Which is very interesting because they're usually the sector that leads us out of a recession.
Yeah, and that is very interesting because we still haven't been defined yet as a recession.
The dating committee hasn't given us a label yet.
And let's explain that real quick because there's an organization, the acronym is the NBER, the National Bureau of Economic
Ridiculousness.
Relationships. I don't know what
Rear view investing.
Exactly. And they have a committee. They call it the dating
committee. Yes.
Dating committee.
And they go back and quite literally date when we were in a recession.
So what they will do is 8 months from now, they'll look back and say, oh, okay, we saw this data and we believe we were in a recession in Q2 of 2022.
What's important to add here, though, is that while it is a very common indicator as far as 2 negative quarters of GDP indicating a recession, there have been times where we in the United States have seen 2 quarters of negative GDP, but not necessarily been classified as being in a recession via the dating committee down the road. So while it has happened with every recession, it has also happened without a recession.
Yeah, I mean,
there are other qualifiers that they look for.
The 2 negative quarters GDP is kind of like the rule of thumb.
The dictionary version of
rule
it.
of thumb of it. But, then I got to tell you that inverted yield curve since March, that has been an indication.
Yes.
And we are still extremely inverted. And let's get into this because bond rates are really, they're raising rates because they want to slow the economy. So when they raise rates, naturally, things like mortgages are going to be a little more expensive. Your credit card's a little more expensive.
A brand new mortgage, not your
brand new
mortgage.
mortgage.
You already have a mortgage.
Unless you have an ARM, an adjustable rate.
Or a HELOC.
Exactly. But, credit cards, I think a lot of people use.
Yes. And if you carry a revolving balance on your credit cards, you are really going to start being punished as far as your interest rate payment.
So
that interest.
We have now, think about this. Not long ago, a 10-year treasury was 150 basis points or 1.5%.
I mean,
so you give the U.S. government your money for 10 years, they'll pay you 1.5% a year, which is safe. You're not going to lose if you hold it 10 years. Today, the 10-year treasury is at
4.12%. It's the highest. Well, it flirted with it earlier today.
Yeah.
And it was the highest that it's been since 2008. Speaking of that inversion
okay.
of the yield curve, that was further today with the 2-year hitting 4.54%, which was the first time it's seen those levels since 2007.
But the inversion's not getting wider. There's still about 50 basis points.
Right. It seems to be in line with each other.
They are. But so what an inversion means is that you can give the government your money for 2 years and make more interest than you would for 10 years. It sounds odd, right? You would think that the longer you let somebody hold your money, you'd make more.
It's definitely more counterintuitive.
It absolutely is. So the 2-year is around 4.5%, while the 10-year is 4.1%. So what would you rather do? Now, obviously, some people, the reason they would go with 10 years, there's a couple of reasons. Actually, there's really one reason, is that you think rates eventually will go down, which they will.
We were just talking about them, in a blink of an eye ago being 1.5%.
Right.
So
they'll come back down, maybe not ever that historic low, but you're locking your money in for absolute safety, 100%, full faith and credit, United States government for 4.1%. And that's
10 years.
Not bad.
No.
Nikki, we've talked about this because
opportunity is knocking.
Since you've been in the business, there's been a lot of things happen that were
just my life
craziness.
Too, as a millennial. I mean, I just feel so lucky. Is it me?
It's definitely you.
No.
There was never anything going on this much. I mean,
it's pretty interesting that since 2018, I mean, we had that crash in December, not crash, but I mean, we had quite a pullback in 2018 as far as that Christmas surprise that we got. Then 2019 was relatively quiet. 2020, that little thing that happened where we all lost a year of our lives.
Sick.
And then, 2021, you see the rally back, you see Zoom, you've got GameStop, you've got all these different things happening. And then this year, I mean, I never thought that fixed income and treasuries were going to be sexy again. But here I am advocating for people to, with the cash that's frozen in fear that you've got under your mattress, why not put it in a treasury?
You can get 1-year treasury, 4%.
It's liquid, unlike a CD. It's offering a higher yield than a CD does. You're not penalized if you need to get out of it intra-year. It's exciting to have opportunities to talk about within fixed income.
So here we go. I got the yields here. The 10-year treasury is at 4.12.
Mm-hmm.
The 2-year is at 4.55.
Damn.
The 1 year is 4.6. So it's even inverted from the 1 and a 2.
Yeah.
Slightly. So understand if you want to go out and buy treasuries, and I know people are buying the I bonds, and that's a whole other story. But if you're buying a treasury bill is less than a year, which means you could buy them 3 months, 6 months, 1 year. Understand when they say that a 6-month treasury is paying you 4%, it's not paying you 4%. It's annualized. You will get 2%. So the way the treasury bills work is you buy them at a discount.
Right.
So let's assume that par value is $100 or $1,000. You buy a bond for $1,000. So that's what the par value is. But because rates are high, you're buying them now at a discount. So that $1,000 bond, which will mature in 1 year at $1,000, you are paying $963 for it.
Because there is an inverted relationship between prices and yields. So as the yields tick up higher, the prices and that discount that you're buying from par is lower.
And it's a very, very safe investment because you're not going to have a lot of volatility in 1 year paper that all you got to do is hold it 1 year, you get your money back.
And it's backed by the full faith and credit of the United States government.
So again, you're buying the T-bills, the 1 year or less T-bills. The same thing, you're buying also the notes at a discount, but they're paying you interest.
Yes.
So that's how they're doing it. So that being said, it's a pretty smooth type investment. We've been doing a lot of things like some fixed annuities out there that are getting you very similar type returns, but yet leaving it tax deferral, so you don't have to pay taxes on it. There's a lot of strategies we're using, different strategies than when you started 5 years ago. Oh my gosh,
this whole avenue has opened up for me in a way that I've never experienced before in my career. I mean, we used to mock, behind closed doors, certain people's situations that they had been put into as far as just how terrible it was working out for the client because they were seeing their upside being capped at 2% and lowered annually for that downside risk protection that you can't lose. However,
okay, you see that, Nick?
I'm
just making sure.
It's a little obnoxious.
Yeah, it's not obnoxious.
It's not as bad as a sparkly dress. But, I mean, it is interesting. We are now finding different opportunities and avenues for us to pursue for clients with annuities and or clients that are pre-retirees that want guaranteed income because they're going to have guaranteed expenses in retirement.
All right, so I'm going to use and we're going to do this every single time, I think. I'm going to use this word every single time.
Fuck yeah.
Did you just say it?
I did.
Okay.
That is my favorite F word.
That's not the F word I was going to say.
This is one of my second favorite.
I was going to say fiduciary. Fiduciary. That is the F word. Fiduciary is that our alignments, clients, and ourselves, it's in your interest. So we align the interest and transparency. So we're at a higher level than your typical just stockbroker or somebody who just buys you securities for a commission.
This is also something to ask your financial advisor. If you currently have one, ask them, are you a fiduciary?
And a lot of them are. So,
yeah.
But
But
are they
shouldn't
treating
be
you as a
taking
fiduciary?
advice from
Yep.
someone who isn't a fiduciary.
All right, so let's move on because the Yankee game's about to start. So I want to just gonna go through some stuff that will be interesting. The Fed's going to meet
New York
again.
Minute.
A New York Minute, exactly. The Fed's going to meet again November 1st and 2nd. It is a pretty much foregone conclusion. They will raise rates 75 basis points. There is also a high percentage they will raise again in December. I'm not so sure about the December meeting. I don't know. I know for sure November we're getting 75. But at some point, these rate hikes are going to really start kicking in. We are seeing it. For example, used car prices. They're down 10% year to date. They were at 47% last year.
I don't think that's so much the Fed necessarily. I think a lot of that is supply chains, it's chip manufacturing, it's kinks that are being worked out. I think obviously the Fed stepping up and increasing, what auto loans
I disagree
being
because
charged.
Used cars, people still get loans for used cars,
Yeah.
and the rates are higher.
No, they are.
And they have less money to work with.
Yes, but
Inflation's kicking everybody's ass.
But I mean, a used car market that was up 45% last year had nowhere to
It's
go
ridiculous.
but down.
It's ridiculous. And part of that was because during the pandemic, the geniuses at the rental car company sold off their fleets. And then
Well, they didn't also realize though that there was only like one manufacturer of semiconductor chips, and it's
But think about
way
this.
across the pond.
you're Avis or you're Hertz. You sell off your fleet because nobody's renting cars.
They had to.
I get it, but that was stupid.
I long game wise, yes, but they are still beholden to their shareholders, and they had
Yeah.
to do something.
I know. They did. So cars got out there. Now they have to buy them up.
They're right there next to the person
Yeah, they
that's
are.
trying to buy a used car to get back and forth to work. You've got Hertz. You're competing with rental car companies for that fleet.
Yep. Look, the economy is certainly this is a Fed-induced scenario that we're seeing. We know that the Fed is going to continue to ratchet rates higher, at least in the short term. I think next year they may not raise rates at all next year. It's very possible. And the next move after 2022 may be down. I don't know, but I tend to think by the end of next year, you'll see a tick downward on rates.
As far as they'll start to ease.
Yeah.
I think you're right, but I think it's really unfortunate that we have to go through this just ratcheting up all of a sudden to do another about face.
Because they screwed up.
Right. They were late to the party by a long shot, and now they're miserable to be standing next to at the punch bowl because all they want to do is talk about all the things they want to do, but they don't want to see how those ramifications are spreading out through the economy.
So the economy is weakening. We know that. It's Fed-induced.
Right.
But even guys like Jeff Bezos, the Amazon founder, he is the latest corporate leader to warn about the state of the economy. I mean, he does believe that he's cautioning and thinks that tougher times are likely ahead, and that the probabilities that this economy will you better be ready to batten down the hatches is what this is per Jeff Bezos. So my question to you, Jeff Bezos, who founded Amazon, which is the
From
greatest
his mother's
retailer.
garage.
I mean, think about it. I
As a
needed
bookstore.
I needed gaff tape. I ordered it today. It'll be here tomorrow. So
You're going to get a back loofah.
I'm going to do that as soon as we're done here. Is Amazon do you think this is almost a warning for is this not a guidance? I mean, is this a guidance play? Is Jeff Bezos saying, because he knows even though he's not the CEO, he knows what they're doing. He knows how much business. Does he foresee that their orders going down?
I don't know. I feel like this is a bit of a head fake because we have seen so many CEOs come out and lower the bar.
Yeah.
So that then when they produce, they're not doing it at as high of a standard. I don't know because Jeff Bezos is not feeling anything as far as his budgetary constraints.
No, he's not struggling.
Because he's not in their day-to-day with the operations. I don't know if he really has his finger on the pulse of the American consumer.
Your point is very well taken. And think about this. Jeff Bezos, their stock is down 25% year to date.
Yeah.
Why not lower the bar now? Why not say things are really shitty and that any surprise, their stock runs up?
Exactly.
That's a really, really good point. So I do take that point, and I do agree.
I will say, though, to play devil's advocate, if any company has a really good insight as far as how the consumer is doing,
It's Amazon.
It's Amazon.
Yeah, and Walmart.
And Walmart, correct.
Yeah. So let's talk Jamie Dimon. Of course, he's the CEO of JP Morgan. He's warning trouble times ahead. He says the situation is very, very serious. Of course, Elon.
Okay, but wait, real fast.
Yes.
Jamie Dimon was like, oh, we're going to have a hurricane like 6 months ago.
Yeah, I got it.
So he's a little baby.
He is, and but Elon Musk crying wolf, saying that the
That's not
economy
a
is in a
baby right
serious
there.
situation.
Did you see, just because of the whole Elon Musk, now he's actually, going to buy Twitter like we all thought. Kanye West, after getting kicked off of Twitter, is now buying Parler, which is like a right-wing free speech Twitter alternative.
Yeah, I never.
I was like,
I heard of Parler.
I didn't think that someone could be more obnoxious than Elon Musk. And then I remembered Kanye West.
Kanye's
still
more
out
obnoxious.
there.
I gotta tell you, I've said it before. I don't like Elon Musk. I think he's just an idiot, but he's a brilliant idiot. I mean, he's brilliant. What he's done. Yes. I'm not knocking his accomplishments.
All common sense.
Incredible what he's done.
Genius.
But the stupid shit he says and does is ridiculous. So,
also a market manipulator. No big deal.
This just in, his Venmo account with the SEC. Okay. Also,
it's a PayPal account actually, because he was the founder.
Oh, that's true. Bank of America CEO Brian Moynihan, though, however, has told CNBC that per their credit card data,
about the consumer,
they're spying on you. They believe the consumer spending has held up.
And they're still building up their reserves, though, however, in case that takes a turn. But that's what's so incredible about what's happening right now. The Fed is doing everything that they can to destroy demand and increase the cost of not only borrowing, but just everything in general, as are corporations. I mean, their margins aren't hurting. Their earnings are doing way better than they had previously doomsday forecast. And yet the consumer's holding up.
Yeah. And all that being said, though, it's all about earnings because we are in earnings season. And interesting about earnings season. First of all, I think I could speak for you on this one. We love earnings season.
It is so fun.
It is exciting because
so much going on.
You never know who's going to come out better and guide higher or lower or miss or it's really interesting. But
in the tea leaves on the earnings calls.
But there doesn't seem to be this earnings apocalypse that everybody was calling for, and that was feared when FedEx, by the way, got it started. Yep. Because what does FedEx do? They deliver goods. They deliver things that people spend money on. They slash their expectation big time September 15th. So far, with about 62 companies in the S&P 500 reporting, 76% of the companies are beating their expectation.
And that FedEx announcement was the start of a 1 month slide where the S&P 500
Absolutely.
hit a 2-year low on October 12th. So again, I do see that corporations, while they are jacking up the price on a consumer, are lowering their expectations and then over delivering.
Well, think about FedEx. FedEx, they are just the base of the economic, them and UPS. I mean, they ship.
And Amazon.
For people the people like us that shop on Amazon all day long, they are shipping for Amazon.
Right.
And so.
As well as for, not the consumer, as far as just,
So think about this. FedEx has warned. Jeff Bezos made these comments. You have, I tend to think, the banks are being very, very cautious, even though bank earnings have been really, really good.
They're finally getting the benefit of these higher interest rates.
Yeah, I mean, finally, because they can charge 7.22 on a mortgage, but only give you 0.5% on your money market. So the spreads are getting better. But I just think that there's so much bad news is at some point,
something's got to give.
There's going to be a bit of good news. And I think some of the good news that maybe Wall Street may like, not going to be political here, but we have the midterm elections.
November 8th?
Yeah. And I think that's probably going to be good for the stock market because there's going to be more of a split administration, split government.
The market loves gridlock. So if we see Democrats, who currently control all houses of the House, the Senate, and also the presidency, if we see some kind of gridlock within there where the Republicans take one of those, the market will relax. In addition, I think we will see Treasury yields come down, which I think, while maybe a temporary phenomenon, could really fuel that year-end rally that we're hoping to see. Because if Treasury yields stay where they are, we're not going to see it.
Yeah, and so when all this bad news or perceived bad news is out, it just takes, people ask me every day, what's it going to take for this market to go around? It doesn't take anything.
No.
It's just all of a sudden, one day, the market decides, hey, we're so oversold, which we saw last week. We're so oversold, we just want to buy. Because at some point, remember, the market does always hit all-time highs.
Yes.
We say this all the time. We don't know where the next 20% is going to go, whether it's up or down. We do know where the next 100% is going to go, because that is history.
It's also the 500 greatest and most profitable it's 505, and then you got the Dow, but you've also you've got some mixing between there. But generally speaking, it's corporate America. Historically, if you were to bet against them, you would show up as a loser every single time, because we are the greatest economy in the history of existence.
Yeah. And we are going to continue to be that way.
And we're
because
the most productive that we have ever been.
And by the way, even though our economy is going in the shitter, everybody else's is worse.
Exactly.
Everybody else's is worse.
One of the things that we saw today as far as why the 10-year really spiked was because of the EU and Canada came out with their CPI versions or inflation reports, and they were hotter than we had anticipated. Yeah. So this isn't just a U.S.-centric occurrence. I mean, we all, as far as a global economy, embraced really free money policy.
It was cheap money. So we talked about earnings in the last 24 hours. Let's talk about specifically, let's get into Netflix, because Netflix reported earnings that were way better than expected. I know you're not a believer yet, Nikki.
No.
I mean, but when you have this co-CEO, Reed Hastings, I'm going to get the quote here, exactly what his quote said.
And he is brilliant. He has pivoted before. I want to give credit where credit is due.
I really give him credit. He is.
Because it's well-deserved with Reed
absolutely
Hastings.
To what they did. So this is what Reed Hastings said, co-CEO. Thank God we're done with shrinking quarters. That, to me, sounds like he was in a cold pool before. No more shrinkage, baby. So what are they doing to try and combat shrinking quarters?
I mean,
heated pools. Okay,
it's
besides that.
Transparency, I'll give you that. Because he came out in the same breath as saying that. He's like, we did great as far as new subscribers this quarter.
2.41 million net subscribers, topping 1 million estimates.
Much better than the last 2 quarters.
Smoke and mirrors?
Smoke and mirrors. This is the shell game. This is the cat at Tropicana Field moving the ball between the cups. Because as of 2023, they are no longer going to give us the transparency of what those additional subscriber numbers look like, which is how we have valued streaming services until this point.
But I think because their foray into advertising, I kind of understand that, because they're going to focus more now. If they don't have this, you made a comment before we went on the show that of these 2.41 million new net subscribers, only 100,000 was North America?
Yes, and 1.4 was Asia Pacific region.
Okay.
Because North America is saturated.
Right. So the point is, though, they're pivoting.
Right.
And they are doing now, they're going to advertising. They're going to try and screw you guys who are sharing passwords. You're done, baby. It's done. No more sharing.
All those pointing fingers. Use guys.
Hey, I don't share a password with anybody. I pay for my shit.
I pay for my shit, but other people share that password.
Okay.
But there are 4.
So Jeff's going to have to get a password.
Exactly. His cheap ass is not paying for a password. He has access to more streaming services than he had with cable based off of Megan and my dime, my sister and I. So, but anyways,
well, that's what you should do for your father.
Oh, of course. And I am happy to do that. I'm like, damn, do I start paying just for like him to have the profile and leave like the IPN at his address? Because I don't listen when Netflix
you don't like the
comes
content. You're not a big believer. I mean, aside from Ozark and a couple other things.
I recently did really enjoy some stand-up on there, some Ron White, some Nick Kroll.
Ron White's funny.
Oh my God. I had never heard Tater Salad.
He's a Texan, right? Texan redneck?
Yes, until Hurricane Ian, and I got an education, and I loved it.
He's hilarious.
So we only found
cigar smoking, bourbon drinking redneck from Texas. Love that.
He was great. He's like, I didn't want to be intoxicated publicly, but they threw me out of the bar. He was wonderful. But there was only one of his specials on Netflix, and then
get her done, boy.
To YouTube to watch the rest of them.
Right.
There are other ways that I can get around the, the moderation of Netflix as far as whatever content they have, I can get from another site, and they're going to piss me off and other people that like. My dad, as a baby boomer, is not going to go out and set up his own Netflix account. It's going to come out of my bank account anyways. What if I want to go on vacation and I want to put my Netflix password
At the
on
hotel.
my computer or on the TV there? Am I going to be blocked from my own account?
What's your feelings on? I mean, look, we know about their content. We know that they're trying to do what they can with content.
I would pay $6 more to not have. They want to do
What about the advertising?
They want to do 4 to 5 minutes of advertising per hour of content.
Well, think about that. If you
Absolutely
watch
not.
regular TV, you're getting a commercial
DVR.
every
Boom.
10. Yeah, no, I get it.
Absolutely not. This is not the day. I genuinely feel Netflix is going to lose more subscribers. Maybe
Okay.
within North America because we're a bit spoiled here. First world problems I'm talking about.
So you're bearish on Netflix.
I'm very bearish on their pivots because they're not creative. They are cost cutting, and I don't think that that's the way to.
While you say
retain
that,
subscribers.
while you say that, these are the people that were sending DVDs to your home 3 at a time, and
Exactly.
they changed their entire business model.
But none of this
And succeeded.
is that creative.
Okay.
That's what I'm thinking. Maybe they got a little lazy. I
Well,
would
look.
love to be wrong because I have been wrong about them before as far as how intuitive and creative they were. They disrupted all of cable. They are the reason people have cut the cord.
No,
as
you're
far as
right.
cable.
Wall Street loved the news. However, they were up. The stock was up 13% today.
Yeah, Wall Street loved the news, but they also punished them just dramatically when
it's
they
way
lost
overdone.
subscribers. So it's just, I mean,
Yeah.
you know.
All right. So
I'm not gonna throw the
Tesla
baby out with the
Tesla
bathwater.
reported earnings after the close, and the stock was down after hours a little bit. Earnings were $105 a share versus 99 cents. They beat on earnings. They missed slightly on revenue, and the company's making money. Their GAAP earnings for $3.3 billion for the quarter, with the automotive gross margins holding steady at almost 28%. So
And it wasn't all due to regulatory credits, so it's nice to see that they're actually, delivering cars.
Yeah, and the automotive revenue came in at $18.69 billion, which is an increase of 55% from a year ago. They
Also-
seem to be doing the right things here.
We might actually have a chance to see the Cybertruck starting in December on the road.
Yeah, and they're going to start delivering semi-trucks. Did I see that?
No, it's the Cybertruck that they're going to start
Okay.
with. And Rolls-Royce came out with a $400,000 EV that's going to hit the streets in late 2023. So keep an eye out on that.
Yeah, that'll be great. All right, let's take a look. This is a chart on Tesla. I want to show you something. Here's really, really good support. So I think...
If you have ever contemplated owning Tesla, now is the time.
Let me draw a line here.
If you have not gotten in, or if you've gotten in higher and you'd like to average down, this is the opportunity knocking at the door.
This is where, all right, so when Tesla actually got out of this trading range here, okay, this is what you look at technically. It got out of there, all right? Big volume took it out, then you had the big moves. And look, a series of lower highs, which is not ever good. But it seems to me that this 206 to 20-ish level, that seems to be like just a brick wall of support here. Tested it. Not quite as close, but still got down there. And then down here, I just tend to think that down at these levels, people seem to think that Tesla is probably a pretty good opportunity. And we do own some Tesla, and I like it. I own Tesla personally, too.
I do, too. I think this
I
is
own
a
it still
compelling
cheaper
entry
than
point.
here, but you got to remember, these levels, we're at $666
Right.
post-split, the number. Pre-split numbers. So
I own it right around here, pre-split.
and it's been up to 1,000 since then. I mean, will it go back
Exactly.
up there? I think it will.
I do
So,
too.
if you're looking for an
Despite Elon.
opportunity to hold on to a stock for again, nothing here. I'm going to tell you it's going to happen tomorrow. Although today was up a little bit. I mean, we'll see what happens. It was down after hours, but it was up during the day. We'll see how that plays out. But I tend to like Tesla, I think, for the long term.
Is it time to go watch the game?
Yeah, it's getting close. All right. So let's go over a couple other things real quick. Interest rates. We know that's hurting. It is absolutely hurting the mortgage market. Year over year, home sales down 25%. Listings down 22%. Demand for mortgages to buy homes and refinancing fell again. And rates are high. And, Mortgage demand hit its lowest level since 1997.
Home builders' confidence is just, I mean, it has fallen through the floor.
In the crapper.
They think that this is likely to be a year. For the first time, we're going to see a slowing or even a decline on single-family home starts since 2011, because we didn't already have supply problems in the housing market.
If by the way, you see the phone number down there, if you need an F word, a fiduciary, somebody that can really help you, we could do that.
If you'd like a second opinion,
we could do that too. And let's go over your portfolios, take a risk analysis, see how much risk you're willing to take. Here's what we're doing for clients. We're trying to move some stock market risk over to some items that have very limited or no downside, but yet have some really, really competitive good upside. And I think most people could probably benefit from something like that, that kind of analysis.
Try to play a little defense.
Yeah. I mean, and look, I think the market's going higher. I do. I still believe we're in for a year-end rally. November, December is going to be okay.
Third year, baby.
Third year presidential cycle. I think we're going to be okay next year. I think we'll see the events of the midterm elections, which is 2 weeks away-ish.
Around the corner.
I think we're going to be okay too. So, look, this is
I know we're going to be
challenging.
okay. I think that it's important to acknowledge that there's pain out there currently. As long as you don't sell, you haven't lost anything.
Right.
If you stick to the course, if you have someone that can weather the storm for you, that's probably the best way to go.
All right. Well, I really appreciate you guys joining us. And we're going to try next week because our producer, Andrew, will not be in town next week.
Maybe
And we're going
trick or treat. We don't know.
We're gonna try and do it without him. If we can't, and you don't see us on the air, well,
You can replay this one.
yeah, replay it. It's because we're here drinking at the studio. Anyway, thanks for joining us. The Hump Day Market Update. For Nikki Ward, I'm the Stock Doctor Lee Seiler. We'll see you next time. Thank you.